Hey, this is Bitcoin Asset Research with Allard. Today I'm going to talk about STRK valuation. STRK is of course STRK, which is MicroStrategy's perpetual preferred stock. I do want to point out that they have just closed that round of the initial offering, and they ended up getting a huge upsize to $563 million, and they originally were trying to raise $250 million, so that's a gigantic upsize. The public offering price is $80 per share, which is $20 less than their initial offering price, but we're still having an 8% dividend on the $100 liquidation preference value. So really, if you bought in on this $80 per share initial offering, then you're locking in a 10% dividend yield. So just a quick update on the progress of this preferred stock offering, and it looks like it's been going really well. Now here's a quick recap of what STRK actually does. One share of STRK is convertible into a tenth of a share of MSTR common stock. It pays 8% dividend based on the $100 liquidation preference value, and this comes out to $8 per year per STRK share that you own. So this is really a passive fixed income stream that lasts forever. It should be valued as a perpetuity. Now the yield of this will change with the market, because if STRK today is at $80 per share and then tomorrow it rises to $100 per share, then you really just had a 10% dividend yield, and then after it rose to $100 per share, it would be an 8% dividend yield. And if it goes to $200 per share from there, that 8% dividend yield just got cut to 4% dividends. So the yield also changes with the market. That's a very important detail. It is not 8% forever on whatever the spot price of the preferred shares are. So what exactly is this kind of security, and how can we begin to value something like this? How can we assign a fair value to it? So this is the valuation framework that you can find from MicroStrategy's slides. STRK is really the 8% perpetual dividend, and I think a better way to phrase this would be an $8 per share perpetual dividend, because 8% totally changes with whatever the spot price of STRK is. And it also includes a perpetual call option on MSTR common. So if you can value both of these things, then you're able to come up with a fair valuation for STRK. So quick point of nuance about the perpetual call option, which I didn't really stress in the last video, is the fact that the strike price of this embedded option is only $1,000 when you consider it in the context of the offering price or the liquidation preference value. The actual strike price will fluctuate with the spot price of STRK. And this is really how that works. How did we get 1,000 to begin with? It's because if you spent $100 on your share of STRK, then converting it to 1/10 of an MSTR common share, that means you spent $1,000 per MSTR. Okay, so you spent $100 to get 1/10 of an MSTR, assuming you convert, then that means you spent on average $1,000 per MSTR, and therefore that equates to a $1,000 strike price. So that's how that calculation of the $1,000 strike price within the embedded call option, that is how we arrived at that $1,000 strike price. But obviously, if the value of STRK changes, then this implied strike price also changes as well. This is what we're seeing in this example. What happens if you spend $300 on your share of STRK? Well, if you then convert STRK into a tenth of MSTR, then you effectively bought the MSTR share for $3,000 per MSTR share, right? So again, you spent $300 on one STRK, you converted that to a tenth of an MSTR, so your average price for MSTR share is going to be $3,000 per MSTR share. So that's a $3,000 strike price. Your strike price in this case would be $3,000. And from this, we can really derive a rule. Your implied strike price within the embedded call option, it's always going to be 10 times whatever the STRK price you bought in at. But if you sell, you're selling STRK at 10 times the STRK price you're selling at. So there's this inconsistency that derives from how this option is actually set up. And this can kind of seem like a problem at first, okay? Because we're now going to go through what this could lead to from a valuation perspective. The value of STRK depends partly on an option with a moving strike price. Like this is what it would seem like. This strike price depends on the STRK spot price. So we're talking about 10 times STRK spot price, that would be the strike price. So whatever STRK changes to, that's going to change the strike price. But the value of STRK clearly depends on the option value, right? Because it is itself an option. And the option value, of course, depends on the strike price, which itself is moving. So you have this like potentially self-referential thing. And this could get a little bit confusing. But now I'm going to tell you that it's actually not as bad as you might think, because it doesn't really matter assuming volatility is high. And you really have to know a few things about options to understand why. The value of an everlasting call option is basically the spot price of the underlying asset, regardless of strike price. Assuming, this is the assumption, assuming your implied volatility is high. And we're now going to just go through a few examples to see why that is. So here I actually have written out a few different option pricing models, and I'm going to just go through a few different scenarios with a few different strikes. And I have implied volatility on the x-axis, and I have the call option price on the y-axis. Inside each of these three charts, the only thing that changes between these curves is what the strike price I am assuming to be. And I have all three of them plotted right here. So the spot price of the common stock is the same. Only the strike price is different. T is the time in years, so we're assuming 50 years for perpetual, because you just have to go as far out as you can. R is the risk-free interest rate. We're putting that at 5%. Q is the dividend yield. That's going to be 0 because MSTR common has no dividends. And we have here the IV range. So this is assuming a minimum IV implied volatility of 40. So that's right here. And a maximum of 150. So that is right here. So now it's going to plot along a range of 100 different implied volatilities and then give us the call option price. And now I want you to look at the 10,000 strike call option at an implied volatility of 100. See how the value of this call option approaches 330, which incidentally is the spot price that we are assuming for the common stock. So this is something that you have to realize. Because this call option is everlasting, as the volatility increases, it effectively approaches the value of the stock itself. That call option just becomes like a share of the stock. But this only works when volatility is high, right? So when we're talking about a 100 vol asset, it basically approaches 330, which is the spot price of the stock. But as volatility falls, and really you get to this 80 vol point where it really starts to fall off a cliff, the value of the call option really starts to fall off a cliff. As volatility falls, you're looking at an option value that is now not exactly the spot price. So that option value is now significantly less than the spot price in certain instances. But this is the $10,000 strike price, right? So this is assuming that STRK would have a spot price of $1,000, and that's going to be like over a 10x from where it currently is. So this would be a very, very outlandish assumption. But I'm showing this to you so that you can get a sense of directionally what happens with these option contracts given different assumptions. Now let's look at the $1,000 strike price. So we're going down by a whole order of magnitude. So this is 10,000 strike, and now we are at the 1,000 strike. And you can see the shape looks pretty much the same, right? Assuming a high enough implied volatility, assuming a 100 vol asset, the call option price is still equal to 330, which is the spot price of the underlying of the common stock. And again, it starts to fall off a cliff after you go below 80 implied volatility. And even at the $1,000 strike, it starts to rapidly decrease in value as implied volatility goes down. And we can even go down another order of magnitude to the 100 strike price. And you can see the same thing. The shape of the curve looks exactly the same. It's just that the axes are a little bit different. At the $100 strike price, and this is actually in the money because MicroStrategy currently trades well over $100. Assuming an implied volatility of 100, the option still approximates the spot price of the asset. And then as implied volatility falls, and especially as it falls below 80, that option value precipitously declines. And if you graph all three of them next to each other, you're actually going to see a chart that looks like this. And K, remember, is the strike price. So here's your $10,000 strike, here's your $1,000 strike, and here's your $100 strike. In all three of these cases, you have at 100, as in a 100 vol asset, the perpetual option is basically the same thing as the value of the common stock. So that's what you really need to understand when you're thinking about the valuation of the perpetual option. Like, yes, the strike price does change, but you can see clearly as long as implied volatility stays high, the strike price changing doesn't actually impact the value of the option that much, right? Because here we went through literally two different orders of magnitude of strike prices, and the 100 vol asset shows basically no change at all. Now, what does impact the value of the option? Well, if the value of the option is always going to be equal to the spot price of the common stock, then really it's the spot price of the common stock that's going to impact the value of the option. So here I've done the same exact graph, except rather than varying the strike prices of the option contract, I've varied the spot price of the common stock. So at a common stock value of $300 per share of MSTR versus $500 per MSTR versus $1,000 per MSTR, you have these option curves with respect to implied volatility. And you can still see that the pattern that we've established here is basically consistent. It's saying that at a 100 vol asset, the spot price of MSTR is going to equal the value of the option contract. But as soon as you start departing from 80% implied volatility, you're looking at a potential degradation of that option value. So what is the main takeaway of going through this whole exercise? It's to realize that the strike price doesn't actually matter that much. And the perpetual call option is very much valued on the value of the underlying, on MSTR common. Okay, so let's take it back here. So the embedded call option could be strike 1,000 or strike 10,000, and it doesn't really matter if the implied volatility is high. And when we're talking high, we're looking at about a 100 vol asset. So the more important thing than strike price is the perpetuity value. It's that $8 per year dividend. So the actual value of a perpetuity is easy. It's just P equals annual cash flow divided by the discount rate. And you can think about discount rate as the interest rate. So here we have, assuming a 5% interest rate, 8 divided by 5%, that's $160 value for that $8 per year dividend income stream. But let's say rates go from 5% to 10%. Now you would do 8 divided by 10%. You would get a perpetuity value of $80. Or let's consider what happens when rates go to 2.5%. So now you do 8 divided by 2.5%, and you get P equals $320. So the value of P is very, very sensitive to interest rates. So now going back to the valuation framework, it looks like we basically have everything we need. We know the value of the perpetual call option. That's basically just a tenth of MSTR common, assuming volatility is high. And we know the value of the 8% perpetual dividend, and that is just the $8 per year divided by whatever interest rate assumption we have. So now that we have both of these, we can add it together and we get the STRK price. Now, if you're finding this video helpful or interesting, I just ask you to help by showing a little bit of class. And what I mean by that is comment, like the video, ask a question, share it with a friend or someone you think will find it interesting. Subscribe to this channel. It would really help out a lot. I would really appreciate it. So the everlasting call option, again, assuming high volatility, is simply a tenth of the value of a share of MSTR, and you have an interest rate assumption. You could just add the two together to get your STRK fair value. So it'd be 8 divided by your rate assumption plus MicroStrategy's price divided by 10. So this would be the fair value of STRK. And you would just have to plug in whatever values you think is appropriate. Again, this is assuming IV is high. If IV is low, if it goes to like under 40 or something like that, then this value starts to collapse, and that's going to impact the value of STRK. So this still is somewhat supported by a higher implied volatility thesis. Now right here, we're basically done with the valuation exercise because you know the MSTR price at any time, and you can generate an interest rate assumption at any time. So over here, we're basically done. But assuming you want to like see a bunch of different scenarios, I am going to go through a more like robust valuation method for options in particular. And the two common ways of pricing options, you got your binomial tree and the Black-Scholes model. Now both are okay here. I actually did both and I got basically the same exact answer. This answer is also the same exact heuristic that we just laid out in the previous slide over here. You can do all of this work, you'll basically get the same exact thing as just the perpetuity value plus a tenth of MSTR common. But let's go through this as just an intellectual exercise, right? So given MSTR price, MSTR's implied volatility, and an interest rate assumption, you can price both the option and the perpetuity and then add the two together. And this is the table that I generated doing all of that. And just to be clear, I used the binomial tree method to generate these numbers, but if I used Black-Scholes, that actually gives pretty much the same exact thing. So how do you read this thing? Well, first off, it starts with an implied volatility assumption. So this is the 40 vol assumption. You would look up the interest rate assumption. So let's say you assumed 8%, and you would look up the current price of MSTR. Let's say it was $300, and you would just go down the table and see, okay, that is valued at 129.47 at 40, assuming a 40 implied volatility for MicroStrategy. Now, if you had another implied volatility view, like let's say you said the implied volatility was 90%, well, you can then do the same thing. And let's also say that you have a 5% interest rate view. You go to 5%, and let's say that MicroStrategy was trading at $500 per share. That's 500. You'd come right here and you get 210 per STRK. So this is really how you would use this kind of table. And again, just going back to here, the only variables you would need is MicroStrategy's price, its implied volatility, and the interest rate that you are assuming. So given these three variables, and all three variables are visible here. Here's the implied volatility, here's the interest rate, and here's the stock price of the common stock. Now I do want to point out one other interesting thing here. I actually wrote this code in a different format where it kind of gives you the breakdown of the price that you would get for STRK, the amount that the perpetuity accounts for, and the amount that the option accounts for. And you can kind of go down this table and see which force begins to dominate at certain periods in time. So let's look at this 40 implied volatility scenario. If your interest rate is at 2%, then the value of the perpetuity absolutely starts dominating. So the way to read this thing is value of STRK is first, then the next one is the value of the perpetuity, and then the next one is the option value. And this is just the percentage that the option value occupies within this number. So all I did was I took this 20.37 and divided by 420.75, and I got 4.8%. So every single line over here represents a unique assumption, and then I'm looking at how much does the option value contribute to the value of STRK. And of course, because it's only those two things, you just do 1 minus this percentage, and you would get how much does the perpetuity contribute to the value of STRK. So when we have something like this, we can actually begin to see how much of an impact MicroStrategy's stock price has versus how much of an impact interest rates have. So let's just look at the 40 implied vol example. At 2% interest rates, this is how much impact the option has. Okay, so assuming the stock goes up to $1,000 per share, the option tops at a 16% contribution to the total value of STRK. But let's see what happens at a higher interest rate assumption. All right, so this is still at 40 vol, 9% interest rate. And you can see that at 9% interest rate, the value of the perpetuity starts to shrink like crazy, and the value of the option starts to dominate, and it actually becomes 53% of the value of STRK. But if MicroStrategy was trading for lower, like at $300 per share, that option value is still only 25%, even at a 9% interest rate. Now let's see what happens at a higher implied volatility. So this is the highest implied volatility that I assumed for. at 140 implied volatility. And we can go to the case where the perpetuity value would shrink the most, and that would be at 10% interest rates within my model here. And you can see that assuming 10% interest rates and a $1,000 price for MSTR common, the option value only makes up for 55.5% of the STRK value. So what that tells me after doing all of this is that interest rates are what dominates the value of STRK. STRK is very much going to be sensitive to interest rates. If rates go down, you're going to have this thing going to highs. If rates go up, you're going to have this thing hitting lows. And it's actually not that impacted by MicroStrategy's spot price. We can see that in some of the most extreme scenarios where MicroStrategy is trading at $1,000 per share, the option value only accounts for just 55% of the total value of STRK. Now, could this change? Absolutely. You can see the trend over here from $300 per MicroStrategy share to $1,000. This trend of the option value starts to go up. And it is, of course, going to keep going higher. Like, let's say if MicroStrategy was $10,000 per share, well, now you would have an option value of $1,000, and you would have a perpetuity value still of 80, assuming the 10% interest rate. And 1,000 over here versus 80 in the perpetuity value. Now you're looking at the option value occupying 90% of the value of STRK. This is kind of just an exercise to get a sense of where we are at. Given any assumption you have, you can always plug it into a table like this in order to figure out what the fair value of it is. So what is the actual fair value right now? Well, if I were to do this, I would assume a 90 vol. So I would come over here and I would probably assume a discount rate that is quite high. So I would put it at, so I would say a 10% or an 11% discount rate. And the stock price right now is between $300 and $400. So I put it at right between here. So right between $103 per share and $113 per share. And this would just be my final answer for valuing STRK. Now, there are assumptions that I'm making over here, and it's important to know what assumptions are going into your model. First off, we assume that MicroStrategy's price and implied volatility are both exogenous and independent from each other. This is obviously not an assumption that works out all the time, because we know for a fact that when the price goes up, the implied volatility tends to go up too. So there's some kind of self-referential feedback loop that we're not going to be able to account for in this simple option model. We're also assuming, in the very naive case, that the interest rate is the risk-free rate, when it probably should be at a risk premium. And this is actually why I put it at 11% interest rates, because I don't think we should view this as a risk-free asset. I think you definitely need to put some more risk premium into it. There's even the case that the company doesn't have to pay the dividend on time, and they could kind of push it off under certain cases. So that is also a risk right there where, hey, if you might not even get paid on time, then you would have to attach some kind of risk premium, if not just for the inconvenience of that kind of situation. So yeah, that's another thing. Like, it shouldn't be a risk-free 5% interest rate. You should definitely include some kind of risk premium. Now, these parts of the model do not align with reality. So neither the price and IV being independent align with reality, and the interest rate stuff also does not fully align with reality. So that's going to skew the valuation in some ways. Sometimes it'll skew it to look better, sometimes it'll skew it to look worse. The important thing to realize is what exactly are the factors that could cause this model to not reflect reality. And that's what I'm talking about here by summing up what the issues are. So that was the video. I hope you enjoyed it and found it helpful. If you liked this video, consider hitting the like button, consider subscribing to the channel, or leaving some kind of question or a comment. Thank you so much for watching, and I'll see you in the next video. Bye.